Around 55% of Americans invest in the stock market. More than half of us are dabbling in stocks, chasing the dream of financial freedom. So if you've got a little money set aside or you're looking to diversify your income streams, this is a perfect place to start. Understanding the stock market isn't an exclusive club for Wall Street wizards or those with finance degrees. Nope, not at all. It's a place for everyday folks like you and me to grow our wealth. Before you start picturing yourself as the next Warren Buffett, let's take a step back and break things down. The stock market can be intimidating, right? All those numbers, charts, and jargon can make your head spin. But in this video, we're going to demystify it all, one step at a time. We'll start with the simple basics, slowly climbing the financial ladder. So subscribe to the channel, and here we go. What is the stock market? When talking about the market, we're referring to businesses selling a part of their ownership, known as stock, to folks who want to invest. This is a handy method for companies to gather funds without taking on debt. Trading these company stocks happens on something called an exchange. Imagine it like a bustling marketplace, but for stocks. The biggest of these is the New York Stock Exchange, NYSE. That's where big companies like Citigroup, Nike, and Walt Disney go to trade their stocks. The runner-up in magnitude is NASDAQ, a favorite spot for many tech firms, including well-known names like Apple and Facebook. When you overhear someone saying the market is up or it's down, they're typically referring to a kind of market scoreboard called an index. This index keeps track of how a particular group of stocks is doing. Two of the biggies are the Dow Jones Industrial Average, which keeps an eye on the stocks of 30 large U.S. companies, and the S&P 500, which follows the stocks of, you guessed it, 500 companies. Investors look at these indexes like yardsticks, measuring how different parts of the market are performing. A lot of investments compare their progress to the index, seeing how high or low they stack up. How does the stock market work? Imagine you have a product you want to buy or sell. What do? Well, you hand it over to a middleman like a broker or an online store, right? This is similar to what happens when you decide to buy or sell a share in the stock market. You're actually dealing with other people like you who are looking to buy or sell their shares. Now, think of a big marketplace like a giant mall. That's similar to the New York Stock Exchange. When you place your order, you send your product to the mall's trading floor. But these days, things are changing. More and more, trading is happening virtually, kind of like online shopping. The actual physical floor is becoming less important. Here's how it works. There are two main prices you need to know about: the bid and the ask. The bid is like the price tag you, as a buyer, are willing to pay for the product. On the other hand, the ask or offer is the price that the seller is willing to accept for their product. When the buyer's bid meets the seller's ask, a deal is struck. This is when the actual buying and selling takes place. In simple terms, it's like when you agree to buy a toy for your friend's asking price. Once you both agree, the sale is complete. That's essentially how trading works in the stock market. What factors affect stock prices? If a large number of people desire to purchase a certain stock, the cost will shoot up. This scenario encourages those who already own stocks to sell them and make a tidy profit. However, the value will drop if many people want to unload their stocks and there aren't enough interested buyers. Countless factors can tilt the scales. Prospective buyers might be drawn to a stock like bees to honey if the associated company announces higher profits than everyone thought. Or perhaps the company's business line is suddenly the town's talk. On the flip side, sellers might decide to part ways with their shares because of an unexpected heavy loss, or if there are worrying signs about the local or global economy taking a downturn. Maybe they just decide it's time to reap some of the fruits of their investments. Tips for beginners. Now that we have a basic understanding of the stock market, here are a few tips for beginners to keep in mind as they start their investing journey. Tip number 1. Buy the right investment. Picking the right stock to buy can seem simple, but it's not as easy as it looks. Anyone can spot a stock that has been doing great before, but guessing how a stock will do in the future is a different ballgame. Now, if your aim is to shine by putting your money in single stocks, you'll have to roll up your sleeves and get ready to put in some serious work. This will require studying a company closely and making smart decisions about your investment. Tip number 2, steer clear of individual stocks if you're new to this game. We've all had that experience of hearing someone boast about their considerable gains from a particular stock investment. What's often overlooked, however, are the other investments they've made that did not fare well over time. This leads to a distorted vision of the potential earnings from the stock market. It's common for people to muddle luck with skill. Occasionally, you might strike gold by choosing a single stock, but staying lucky in the long run and evading major dips in value is a huge challenge. Don't forget, to reap steady benefits from single stocks, you need to have some unique insight that the market hasn't already factored into the stock price. Keep this in mind. For every person selling their shares, someone else is buying them, equally confident of making a profit. Tip number 3, create a diversified portfolio. An index fund's primary benefit is its immediate accessibility to a variety of stocks. For instance, if you have an extensively mixed fund based on the S&P 500, you're actually owning shares from numerous companies spanning various industries. Alternatively, you could choose a narrowly mixed fund, focusing on one or two specific industries. The significance of diversification cannot be underestimated. It diminishes the risk of a single stock adversely impacting overall performance too significantly, thereby enhancing total returns. If you contrast this with purchasing just one stock, it's like putting all your money in a single place. Investing in an ETF or a mutual fund is the simplest route to fabricating an assorted portfolio. These products inherently come with diversification, saving you the task of analyzing the companies included in the index fund. Tip number 4, get ready for a possible dip. The toughest part for many of us who invest is dealing with decreased investments. And seeing that the stock market can swing up and down, you'll sometimes face these dips. You need to brace yourself to manage these dips, or else you might buy when prices are high and sell when they're low during a frenzy. However, if you spread out your investments, no single stock you own should greatly affect your overall earnings. If it does, owning individual stocks may not be your best option. Even index funds will swing, so you can't eliminate all of your risks despite your efforts. The idea of ups and downs in the market can be a bit tricky to get. Even if you have been investing for a while, we must remember, you've probably noticed that the market seems unstable when prices are dropping. But guess what? It's quite fascinating because prices can be just as unpredictable when they are on the rise. Yes, that's right. Even when the market is going up, it can be all over the place. And that, my friends, is what we call volatility in the market world. It's like a seesaw that never stays still. Sometimes it goes up, sometimes it goes down, but it's always moving. Whenever there's a shift in the market, we often tend to recoil or rethink our choice of investing. But the stock market is a long-term game. If you're investing for years or even decades, it's important to remain steady and stick to your investment plan. So, if you liked this video, make sure to like, comment, and subscribe for more tips on the stock market.